Rio Tinto Group engages in exploring, mining and processing mineral resources worldwide. The company offers everything from aluminium, copper, lithium and iron ore to diamonds, gold and salt. It has a market cap of $107 billion and it is the fourth biggest mining company in the world by revenue. So not a small operation. And there are at least a couple of reasons I think it is worth taking a closer look at Rio Tinto Group. So let's analyze it, value it and see how good can this investment actually be. Individual insiders. It is an X. Only 0.05% of the company is owned by individual insiders. And we would like to see this number over 2%. So unfortunately, the management does not have its skin in the game. And are individual insiders buying right now? That is a check. In the last 6 months, we see 7 buy transactions worth just under $100,000. So the management is buying recently, and that can be a sign of their confidence in the future of Rio Tinto or their belief that the price is right. And what about super investors? Do they own Rio Tinto? That is an X. In the last quarter of 2021, Lee Ainsley sold his ownership in this company and no major investor has been involved since then. So, of course, super investors are not buying right now. Return on invested capital. That is a check at 12.2% 10-year median returns. And we want to see this number higher than 10%, so that is a nice beginning. And free cash flow growth? That is a check at 18% annual growth rate. So that is a very nice result because just as with return on invested capital, we would like to see this number higher than 10%, and here we are getting close to double that. And what do we know about net profit margin? It is a check at 22.3% margin, and the industry average is 9.6%. So probably the scale of this operation allows it to be more profitable, and the company can have a major advantage over most of its competitors. And now let's take a look at share buyback. It is a check. In the last 10 years, they bought back 12.3% of their shares. So that is very good news for long-term investors. If there are less shares of the company out there, then every share you own represents a bigger portion of this company and therefore it is worth more. And what do we know about the debt? It is a check. It would take only 1 year to pay the long-term debt with a current free cash flow. And we want to see this under 2 years. So that is very nice. And looking at the whole financial health of Rio Tinto, we see something very appealing. It is not often that we get checks all around. And well, I have to say I like that. The dividend yield is 7.6%, so we can expect to get $4.92 annually per every share. That is a very nice yield, but let's take a look at the payout ratio. That is an X at 64%, and we want to see the payout ratio somewhere between 20 and 50%. Such result means that they are putting 64% of their income into dividends, and such high percentage may slow the growth of a company. But in this case, we are talking about a very mature company that probably can't grow too fast anyway. So I would not treat this as a major concern. And what about the dividend growth? It is an X. The dividend is actually going up and down in different years depending on the results and future plans of the company. So it is impossible to actually predict what dividends we can expect in the future. One thing that seems pretty certain is that they will pay some dividends, but the amount is a mystery. Rio Tinto Group has a current price-to-earnings ratio of 8.5. That seems pretty low, but before we jump into any conclusions, let's value this company using a discounted cash flow formula. We will estimate the growth of Rio Tinto for the next 10 years, and we will create 3 scenarios of this growth. So, in the low scenario, we will estimate a decline of 3% for the first 5 years and then 1% growth. In the medium, 2% and then 5%, and in the high scenario, 5% growth for the entire 10 years. Now, why did I choose such growth rates? Well, when we look at the growth of this company in the last 10 years, we see that the revenue grew by 0.9%, free cash flow by 18%, and earnings per share by 16%. So, why did I choose much lower growth rates? Well, for one, we want to be conservative, because that can save us from getting into some serious trouble. But that shouldn't justify such a difference. So the main reason is the fact that Rio Tinto's management has warned that labor shortages, muted Chinese demand, falling commodity prices, and the threat of recession are rising considerable headwinds. So the management anticipates some serious problems in the coming quarters or even years. That is why I prefer to be too pessimistic than too optimistic. So, with such estimates, the intrinsic value in the low scenario is $60, in the medium $85, and in the high scenario $97. But of course, these are not the prices we should be buying this company for, because we have to always add a margin of safety. I use a 30% one. So with such a margin, we get in the low scenario $42, in the medium $59, and in the high one $68 per share. And the current price is around $63. So we have only the low scenario without the margin of safety in the red, and low and medium scenarios with the margin of safety in the red. And the difference is not that big either. And other scenarios look really nice. And such results can indicate that this company is actually fairly valued at the current time. So we have a company that has great financial health, including low debt and high margins, pays a nice but unpredictable dividend, management is currently buying shares of this company, and the price seems to be fair. And the last thing that makes me wonder is the statement from the management that they are anticipating strong headwinds. And that can either be already priced in, or if we are going to see some weaker results in the coming quarters, the price may actually go even lower. So tell me, what do you think? Is it a buy now, or is it still a bit overvalued in your opinion? Thanks for watching, and see you in the next one.